I'm honored to introduce Professor Gauti Eggertsson. Gauti is professor at Brown University, but in his career, in addition to being an academic, he's also worked at policy institutions like the IMF and the New York Fed. And this shows by the fact that he's very closely followed not only by academics, but also by policymakers and central bankers for addressing policy relevant questions with academic rigor. Such questions have been, for example, forward guidance, the Phillips curve, quantitative easing. And today, Gauti is going to tell us about when do deficits fuel inflation? If I'm allowed a joke, the burning question of the day. Gauti, you have 50 minutes.
Okay, so just to be clear, when I was invited, when Peter invited me to give this talk, he asked me what was the title of the talk, and I decided just to have it as broad as possible. And inflation and deficit seem to capture pretty much a lot of things that I've been working on. So this is sort of well, this was supposed to be a collection of work that I've been doing recently, but as I started doing the slides, I started becoming more and more interested in. I guess that's the advantage of giving a plenary talk. You don't have to give a paper. You can kind of, deviate a little bit. You realize after a few plenary talks, you don't even need a paper. You can have, a fully new thing that you haven't written down. So this is going to be a sort of a little bit of mix of both work that I have done and also what I've been thinking about a lot in the last few weeks, especially leading up to this, which is inflation surges we have seen in the U.S. since the Fed was founded or started operating in 1914 up till today. So that's what this is going to be about, and also sort of I'm going to offer some ideas of how to model it and how new is it relative to what other people have said. I mean, I think I'm still in the process of digesting that. I think it's surely not. You will see. We'll see, and we can debate. So okay. So overview. Oops. I'm going to start by talking about inflation surges that we have seen over the last 10 years. And I think a lot of us, when we saw the inflation surge in 2021, it was actually one of the happiest moments of my life. I'd been spending 20 years or so talking about the zero bound and deflation, and finally inflation. That seemed like something new to write about. And not only that, I was very wrong. I, got it dead wrong. I wasn't expecting it at all. But a lot of us at the time were sort of talking about, what was the cause? Was it demand, supply, temporary or non-temporary supply shock? So it was sort of questions about the mechanism. But in a way, not the cause, because if you think about it, the Fed can always raise interest rate. It's unlike the CLB. I mean, there's nothing you can really do. So when you think about the inflation surges in U.S. history, the question really becomes, well, why didn't they raise rate and eliminate it? Okay, and that's sort of what I'm going to go through. And that's, I think, it offers a little different perspective. It may be because of mistake, it may be because of other reasons. We'll go through. So in some respect, unlike at zero bound, and I hated this phrase, now I love it because it really applies to inflation. And unlike deflation, where it can be constrained, it is always and everywhere a monetary phenomenon, regardless of sources, like Milton Friedman said in the 70s. Okay, so I'm going to talk first about, a little bit about the mechanism. And then I'm gonna take a little pause that may seem like a needless, uh, needless pause and sort of running down a rabbit hole. But that was because a couple of my co-authors were pestering me about why I thought uh, raising interest rates would reduce inflation. And I thought we had sort of settled that debate a long time ago. But I realized, at least in certain corners of the academia, it does seem to be settled. So I just want to spend a couple of minutes on that because it also ties then into the next topic, the physical theory of the price level. And uh, I'm going to suggest so when I what I mean by physical theory of the price level in the way I use it here is really Leeper's 92 paper, where you have sort of active fiscal policy or passive. But what I'm going to suggest is an alternative way of looking at it, where it is not active or passive. It's more like a continuum. There's a parameter you can that you can vary, so you sort of go in between the two extremes. And then is that a better model than Leaper's model or some other model? I guess all models are wrong. The question is if they're useful. So I want to spend the last then minutes that I have on going through the historical narrative of the 6 inflation surges we have seen in U.S. economic history and address the sort of why question. So why did the Fed not raise rate to curb inflation during these inflation surges? And I think I'm going to argue that the theory I propose, which is not, I don't want to claim super novelty here, is tightly related to the fiscal theory, but it's just a slightly different twist on it. Okay, so all right, so precise definition can sometimes be hard, and the famous definition of the Supreme Court justice when he wasn't sure, was I know it when I see it. So that's sort of how we try to define inflation surges. We kind of all know when there were inflation surges. Even if you ask ChatGPT, it will pin down a particular type of inflation surges. And this turns out to sort of be a relatively reasonable definition that gives you what most of us have in mind, continuous increase in year-on-year CPI inflation exceeding 4% over a period of more than 12 months with an average of at least 5%. Okay? That's going to be my definition of an inflation surge. With that definition, what you're going to find is on this next graph that shows you the last since the Fed was founded until now. And you're going to see there in red 6 inflation surges. Okay? So the first one is World War I. Second is World War II. Then you're going to have the Korean War. Then you're going to have, I put the Vietnam War, but there was more going on than just the Vietnam War. This is when Lyndon Johnson was president. There was also, his dreams of, he had big plans for the Great Society. There was a tax cut of Kennedy that he implemented. And then, of course, there is the great inflation of the 1970s, which is really the last great inflation surge we have seen until just recently. And it's somewhat unfortunate that I don't know if that's the right, no, it is from the point of view of policy. It is somewhat unfortunate that the 1970s is the last great inflation surge that the Fed has seen, because I think that then became their main frame when they were looking at the inflation this time. And why is that unfortunate? Well, it's unfortunate because that particular surge is different. There's 6 of them. Is unique among the 6 in a way that I'm going to tell you in just a second. So I think people were, maybe overly relaxed because they were looking at the metrics that were relevant to, guard against that style of inflation surge, and perhaps not looking at kind of metrics that were relevant for all of the ones that had happened before. So what were these metrics? Let's take a look at that. So here, and this is from some of my work with Pier Paolo, simple metrics, and I've split this now in two. What is sort of interesting, if you look at the 6 inflation surges in U.S. economic history, well, not U.S. economic history, since the Fed began its operation, is that in every single instance, what you will see is that the number of firm vacancies, how many people firms are looking to hire relative to how many people are looking for a job, when that creeps over, I pick here the magic number 1. We did some empirical work, Pier Paolo and I, that turned out that that was actually surprisingly close to what we estimated in a model that I won't go into, and was the number that Beveridge, who was the founding father of labor economics, argued was the balance when the labor market was balanced. So you see here World War One, World War II, and the Korean War. In all these cases, you see, I mean, it's you see that this labor market tightness. I just want to point out to you here, one of the things I've learned in this is that price controls that I lived with in Iceland, they do seem to work to some extent, at least on the official numbers. I mean, they don't work in a lot of other ways, and I'm not in favor of price controls, having had to live with them in Iceland growing up. Okay, so these are the first 3. So let's see the next 3. So here we see the also the one just before the inflation of the great inflation of the 1970s is actually a surge under Lyndon Johnson during the Vietnam War, during his construction of or attempt to construct his ideal of great society and massive tax cuts when the economy was close to full employment. That's this surge here. And then you enter into the 70s, and that's where you see something different happen. That's why the 70s are so different from the other ones. And you kind of all know the reason that, we got even a new word. It introduced a new word into the econ lexicon, stagflation, right? The labor market was not tight. And yet at the same time, we had this massive inflation, right? So that, I think, was very much the prism through which policymakers were looking at the problem of inflation. We're not looking at the Johnson inflation. They were thinking about, because this is also the longest episode of an inflation surge in the Fed's history. So, and it was the last one, so it was natural for people to look at it. But you see also that this one here, post-COVID, is associated with very tight labor market, and this is actually by this metric. Remember, so this metric here is number of workers firms are looking for relative to the number of unemployed people looking for jobs. This is the tightest job market according to that metric since the Second World War. Okay, and what's interesting about it is that it was tight according to that metric, even if unemployment was, when the inflation was taking off, unemployment was around 5.9, and a labor participant, but firms were just desperate to look for workers, and so there was some sort of a mismatch. I think part of it was, I mean, we could go into the details for that. I'm not going to do that. Part of it was that the demand for goods was growing faster than services. And there's several reasons why, overall match efficiency in the economy was going down. So that's sort of what was really special here was the 1970s, because it was out of those 6, the only one where the labor market, as measured by theta or vacancies over unemployment, was below 1. It was on average over the time period 0.6. The traditional reason, and I think it's a pretty reasonable one, is that expectations became completely unanchored. I think I have a figure showing you that, but I mean, you kind of know it anyway. You don't even need a figure. And we learn it like one of the first things we learn. Uh, and one interesting question there is, and that's one I will address, is why did the Fed not raise rates during the 70s under Arthur Burns? And I'll get to that in a later slide in case I don't get to it. It was because he didn't think it would do much. So you had a Fed chairman that didn't think he could do much to reduce inflation by raising rates. Uh, and it was not his problem. So no wonder expectation went all over the place. So I'll show you some quotes. Uh, uh, yeah, I'll get back to that. But it created a very unfortunate background for what we faced in 2020, which was a lot more similar to the other surges we have seen. Generated, the mechanism was tight labor market, not anchored expectations. So people drew a lot of comfort. So this is the Livingstone survey, just one of many. It has the advantage of going quite far back. The survey and it's just 1 year ahead. And you can see just, there's just a minor blip, and this is just 1 year ahead. If you look further ahead, expectations were extremely stable. In contrast to during the 70s, even when Volcker started cutting rates, people were expecting inflation to stay at 10% for 5 or 10 years. I mean, it was really ingrained. So people were very comforted by the fact that, the stories people had told them about how does inflation occur. Well, it occurs because expectations becomes destabilized and feed directly into inflation. And then a lot of work came to the conclusion that the slope of the Phillips curve was tiny. So there's a well-known paper by Nakamura, Steinson, Hirano, and I'm forgetting the Hazel, I think. Well, I'm not sure. But, in QG, they find that, 1% increase in unemployment is only going to decrease inflation by 0.34. So, even if you would have a big stimulus, it was not going to do a whole lot. And that was the view that people took at the Fed. And we have speeches for like Lael Brainard that say exactly that. And that's related also to the new policy framework that took up. So they were just not thinking that expectations were stable. It was it was little to be expected in terms of pass through. Maybe some supply shock, but if you look at traditional measure of supply shocks, they were not that great during that period. You would have to look at more untraditional one like supply chains, things or things of that sort. But that was sort of expected to be temporary. Uh, what then came as a surprise to a professional forecaster and the Fed persistently, and I have a big picture of that here, but in some of my other work, they were continuously surprised by the inflation. And that sort of ex post, by the way, I was also continuously surprised uh, until I think in the fall, because then it should have been obvious. But they didn't raise rate until March, which was a little bit surprising. In retrospect, maybe we shouldn't have been so surprised, because if we just looked at, if I had looked at my uh, textbook at the University of Iceland, it was so old-fashioned that it had basically like paleo Keynesianism, meaning that when you were below capacity, this is a supply curve, any increase in demand was not going to do a thing about inflation. But you can't have a flat Phillips curve no matter how much you increase output. At some point, you're going to run out of people to hire, right? And that was what was going on in the US. You would go into a restaurant in Providence and say, family of 6, and we go into a restaurant, it's 1/3 full. And they say, can we have a seat? And I say, no. I say, what are you talking about? We're full. What are you talking about? I have the restaurant. Oh, labor shortage. This was going on all over the US, right? That you had stores closing over certain hours, and you would just at capacity even, and that was captured by this measure, but not by traditional one. Okay, and so it seemed like people had sort of forgotten that lesson that Keynes and Friedman were fully aware of. I mean, Friedman has a plucking model that is exactly about that you bump up against the ceiling. And Keynes had something he called like a wartime economy, when you're also bumping up against the ceiling. Okay, so this is just data. I'm not going to talk about this. It's a little bit about now the latest search. If you would just plot up the 60s, this is just raw data. This is raw data showing you tightness or log of tightness, and then inflation, and just plotting it out. And God, doesn't it look awfully suspiciously much like what I saw in my textbook in Iceland, like an inverted L. And then, people were spending their time estimating data during the cloudy period here, from the 70s up till 2018 or so, when, not a whole lot was going on because the labor market was never tight. And this here is from advertising here from my former student, Julia Giddy, who collected data from MSA regions in the US from 2000 to 2023, where you see a sort of a similar pattern. Okay, so today I'm gonna though ask a different question. I think the inverse L New Keynesian Phillips curve that I've sort of just loosely talked about, I'm convinced, although I wish everybody was, but so surprisingly, not everybody is. I think it's obvious, but some referees don't agree that was a clear mechanism. But I want to ask a different question today, which is why did the Fed, reign over these 6 episodes? Okay, and that's where we're going to go next. Because I do agree with Friedman on this. I hated this comment when I was doing work on the zero low bound, and people will say, "Oh, just print money, because inflation is always an area of monetary phenomena." He was using that in the context of the 70s when Arthur Byrne was making excuses for that. This was not his problem. He would say, no, inflation is always a monetary problem. And I think certainly on the upside, that's the case. So the question is then, why did the Fed not increase the interest rate and prevent at least some of these 6 surges since 1914? Okay, and I'm just going to go through them, but I'm going to try to offer somewhat of a theory first. But first, surprise pause, which is, are we so sure increasing interest rate reduces inflation? As far as I'm concerned, yes, and I would have just moved on. But I was surprised when I was talking to some colleague, including a co-author, that this is in some corners of the academy there's a surprising number of people in the profession that say they're not sure. In fact, I think I gave a keynote speak where when I was at the ECB last time, or a panel where people were arguing that we should raise interest rate to increase inflation. I haven't heard as much discussion of lowering interest rate to reduce inflation now, but that would be the logical, that would be logical based on that. But people talk, no, I don't think interest rates are important. They start talking about some notion of money, government debt, fiscal theory, the price level, substitution of income effect, and so on and on, okay? So let's just go through what I think is the basic logic, because I think some of this criticism appears to have arisen through a paper, which I remember first seeing. I was actually just looking it up. I thought it was shorter ago, but I guess I'm that old. It's almost 20 years ago when Cochrane presented his paper on that New Keynesian economics didn't make any sense at a EFG meeting in New York. And I remember none of us there thought the paper made any sense, and we discussed it. And I remember asking Mark Curtis, should one write a response, and I said, "Oh no, people figure it out." 20 years later, I don't think people are still arguing, or he still claimed the same thing. So what were his claim? He was claiming that according to the New Keynesian logic, which is sort of the logic that I think through, old Keynesian ideas of raising rates, lowering demands, lowering inflation did not apply. Then another thing that he associated with New Keynesianism, which is not really necessarily New Keynesianism, but whatever, was that the Taylor rule was some sort of a off equilibrium thing, not observed in the data, and somehow devastating for how we were analyzing monetary policy and the effect of increasing interest rate. And that equilibrium in general was being determined by blowing up a threat of central bank to blowing up the world. So these two equations are actually from, I was Mike Woodford's RA when he wrote his book Interest and Prices. So I know every chapter and every verse, very well. So this is from chapter 2. I sometimes wonder if Cochrane just didn't get to chapter 3 because, that's where we're going to go in the next slide. uh, so, uh, because so Mike did have these two equations in chapter 2, and it was just a very elegant illustration of an indeterminacy result of Sargent and Wallace. It had nothing to do really with New Keynesianism. It was just about showing that, if you have constant interest rate, you get indeterminacy. That's it. And it was done in a model with flexible prices. So, it was an endowment account. So this R here was moving because endowment was moving. So prices were perfectly flexible. Somehow, though, he came to these conclusions and claimed that old and new were different. And I just want to back very quickly. So this is the standard New Keynesian model. Output depends on expected output, real interest rate. And then let's put a demand shock here of natural rate of interest. And I'm not going to bother even with the expectation here and just have an old-fashioned Phillips curve. You could put the expectation of the New Keynesian one. It's going to be a supply shock. And then I'm going to have a Taylor rule that is going to have both inflation and output. And here, you get determinacy when this condition is satisfied. And, these here are going to be the equation once you have solved out using this determinacy condition, assuming IID shock. So the expectation is just going to be 0. Okay, so here, what we're going to see then is the new Keynesian logic. Well, you raise interest rates, that lowers demand, check. The lower demand, that lowers inflation, check. Taylor principle. So it's just the same logic. So I don't know what the debate in that respect is about. The argument has then been that the Taylor principle represents something off equilibrium, not observed data. Well, that's just not true when you have shocks in the model. Then, these coefficients here just represents how the central bank is trading off inflation and output. It's nothing more than that. It's no threat about blowing anybody up. It's not central banks are not in the business of such threats to ensure price stability. So I guess that didn't even deserve a special slide. So what are we solving? We're solving this here forward, and we're just insisting on that the only interesting equilibria are those that where inflation are bounded, so it doesn't veer off to infinity. And then this here is going to go to 0, and then inflation is just going to be a function of the shocks. Okay? And these coefficients in general don't represent any threat about blowing things up, but instead just how you trade off inflation and output. Naturally, you would not prefer to have them so that there would be a unique equilibria, because, if there are many possible equilibria, that's one story for the 1970s. But I don't think it makes any sense to think of this unbounded equilibria that Cochrane seems to think is so important as being relevant. I suppose he has in mind hyperinflation, but every hyperinflation, I've studied quite a few. I've written kind of a paper about it. They end. Even in Zimbabwe, the hyperinflation ended. Well, this hyperinflation never ends. It lasts forever. Okay, nobody has ever seen a hyperinflation that lasts forever. So it's a totally uninteresting thing. Moreover, it's supposed to arise spontaneously for no particular reason. We know why hyperinflation happened. It's because of, that the fiscal imbalances. So no example in the history of the Homo sapiens of spontaneous emergence of hyperinflation that increases exponentially forever. That does not mean that there's not a role for fiscal policy. So I'm sympathetic to Cochrane in that respect, and that's where I'm going to move right next, because I think that is, and I think unfortunately some of this discussion about monetary and fiscal policy has been uh, confused into discussion of transversality, condition, and determinancy, things that are sort of esoteric, as opposed to what I think is the fundamental issues, and that's what I'm going to try to. Now, there is a beautiful paper by Leeper, well deserved. Its fame is well deserved because it's a beautiful paper. I'm going to do a variation of that. What I'm going to do, and that is no criticism of Leeper's paper. I mean, it's from '92, so one is allowed to extend that. I'm just going to propose an alternative way of characterizing the fiscal theory at the price level, which sort of nests it, but you're not sort of switching discretely between fiscal dominance and monetary dominance. Now, so why do I want to do that? Well, all models are wrong, but some are useful. So when we look at the data, when we look at history, I think it is useful to think about it that there's a various degree of pressures the government puts on the Fed or the ECB to have loose policy. So I think it's useful to have a model like that as opposed to switching from one extreme to another. Okay. Uh, so here, actually, inflation is always and never going to be a monetary phenomenon, but the president or the treasury may sometimes, harass you and even have you monetize its debt, and like in World War One. Literally, I'll show you exactly what they did then. So, fiscal authorities can exert strong impact on the central bank or the president by firing governors and things like that. Or trying to. We don't know yet whether how successful uh, that was. But actually, this is not the first time a president has tried, because Lyndon Johnson, when you see that second, he was really pushing hard. And, it's a famous story when he physically pushed the chairman of the Fed up against a wall at his Texas ranch, physically assaulted Chairman Martin. Uh, okay, so this is Leeper's classic result, and I'm just going to cast it in the new Keynesian model, and I'm going to have a very simple Phillips curve here. I'm not going to bother with the expectational augmented because it's not crucial here. I'm not going to bother either with the output gap in the Taylor rule, although we could add it. And here I'm going to have, this is the budget constraint, and V here is the real value of government debt that is being depreciated by inflation, right? We're approximating it around a steady state. So if there's inflation, that's going to reduce the real value of the debt. And I'm writing here inclusive of interest rate, meaning then that if you lower interest rate today, it is less costly for you to roll it over. And actually, if you read through sort of history of interaction of the Fed and the Treasury, this rollover motive tends to be extremely strong. That the Treasury is calling the Fed really angry because it's so costly to roll over the debt, the short-term debt. Okay, so this is just Lieber's classic result, just in this modestly different model. That this was an example of active monetary policy when this here is greater than one in absolute value, and the fiscal authority is going to take care of the debt not blowing up by collecting sufficient taxes for interest rate payments. Okay. The other passive monetary policy is that the Fed is accommodating, is not doing, is keeping its interest rate. They're not reacting strongly to inflation, and the Treasury is not collecting a whole lot of taxes. So what needs to adjust then for the budget constraint to hold, because we assume it's a risk-free debt, well, inflation needs to sort of, make up the difference. So you have these sort of two extremes. So what I want just to point out, and then you can also have indeterminacy or non-existence. These are the four possibilities depending on the different kind of combination here. But the active, fiscal active monetary is perhaps the most relevant. So I just wanted to suggest here so this is just here the actual solution for inflation. You get zero inflation here. This is the evolution of the debt. This is taxes. And importantly, what is that? Okay. It was not a message to me, I guess. So this year, I guess I just want to point out to you is that what I want to point out to you here is that when you have a active fiscal policy, then you're going to start seeing output being influenced by debt here, right? And it's going to start influencing inflation then as well, interest rates, and this is going to be the evolution of debt that is going to be stable. That's the key thing, that inflation is going to, and output is going to adjust so that this equation here becomes stable. It doesn't blow up because he's looking for a unique bounded equilibrium. Okay, so do we need to pick between the two? The active and passive? Why? Why not just have a model where fiscal policy can have a effect, a little effect or a lot, depending on one parameter that I'm going to call phi v. So then A and B are going to be special cases, at least in terms of observables, and we're not going to have this awkward thing of non-existence or indeterminacy. There's always going to be a unique bounded solution. And the key assumption here is that what we're going to assume, and that's going to basically establish this, we're going to assume that the real debt is exogenously following this thing here, which frankly, I think is a much more realistic thing that typically people assume in the fiscal, according to the fiscal theory or the price level, that the primary surplus is exogenous, not only today, but forever. So the politicians are never going to adjust, depending. I mean, I told people, my brother is a politician. So all he does is try to adjust the primary surplus because they're worried about stabilizing the debt. So it just, assuming that it's exogenous just doesn't make any sense to me. I think it's much more natural to assume that the debt will be stable. However, you may have cases where the government is going to lean very heavily on the central bank to make the debt burden more easy. Monetary policy can come under pressure. So, and my motivation for modeling it this way is to explain the inflation surge. So here I'm going to assume now that this here is exogenous, not some, not the taxation rule. And I'm going to assume now that monetary policy is given by some different coefficient here. And monetary policy is always going to be active. It's always going to be greater than 1. And then what you can show, you can then pick this coefficient here. If it's 0, well, then you have the monetary dominance. But if it takes this value here, well, I mean, it's expensive. It could be anything, I suppose, but you can find a particular value where it's going to get exactly the same dynamics as the fiscal theory of the price level in the Lieber sense, right? But you can have a bunch of things in between. So in other words, I think it makes sense to think about these inflationary pressures from fiscal policy in terms of pressure that is being put on the central bank. But the bottom line is that inflation is always an area of monetary phenomena. It's just how sensitive monetary phenomena is to the fiscal pressures. I mean, I think that's why the ECB is designed like it is, or the Maastricht Treaty. They want to limit the pressures. So, and I think like determinacy issues and things of that sort, or evaluating transversality condition that a lot of this literature is about, feels more secondary than the fundamental question of how is the fiscal policymaker exerting their influence. By the way, you could also microfound this here, equilibria. So these are ad hoc reaction functions, both in Liebers and the work that I have. But if you analyze a Markov perfect equilibria in the same model, you can get, and you just have this objective here, where you care about tax distortion, then, if this is 0, you get sort of, the optimal targeting rule that only cares about inflation and output. If you get taxation weight, you can actually replicate exactly the fiscal theory of the price level dynamics for the right value of lambda theta. Okay, so there is no correct theory, but there are useful theories and theories that are less useful. So I'm not going to try to claim that mine is more correct than, let's say, Cochrane's or Leeper's. But what I want to argue is that at least I found it useful to think about these inflation surges. Okay, so let's take a look at that. So how useful are they, these different theories, to explain the six inflation surges 1914? I would say that they're quite useful to explain the first four. For the last two, I think we're going to have to reach, I think they're less useful to explain those. Okay, so this is World War One. Well, I have it sort of shaded in the background that you had this really high inflation. Well, who's this guy? He is the Secretary of the Treasury and the Chairman of the Federal Reserve. So that's an interesting arrangement, right? So deficits were in 1918 11% and then 17% of GDP. And remember, the government is tiny at this time. So what did they do? Well, there was just direct monetization of the debt. So what they did, how they implemented it, was that they literally printed reserves that they then lent to commercial banks at a very low rate under only one condition, that they would buy government debt. So I guess for some reason there may have been some rules that they could not directly monetize it, but that's sort of how it was implemented. So this was just a direct monetization. So the Treasury Secretary was just directly monetizing it through basically, lending reserve out to banks, then bought treasuries back on Fed. So why they couldn't just do it directly, I guess, was part of just the legal framework. And that then resulted in the largest inflation spike we have seen during these war years. So I think so here you are just thinking about, well, a central bank that is very reactive to fiscal consideration. What about the World War II surge? So here you have Eccles, who was nominated as chairman in 1934, with a very cozy relationship with FDR and believed in full cooperation between the Treasury. And there were price controls here, so it is a little spiky, the inflation. But this is what he says in the FOMC Open Market Committee. We are not the masters in our own house. We are the fiscal agents of the government, right? So it's just, they were just directly operating monetary policy, putting very heavy weight on fiscal consideration. So how was it implemented? It was not implemented like during World War One. Instead, what they did was that they pegged the 3-month T-bill rate at 0.375 and long bonds at 2.5. There's a typo here. It shouldn't be 3, right? So at 2.5. And this arrangement actually, the war is over 45. This arrangement lasted until 51, March 51. Because the government still had a lot of debt coming out of World War II. And it was only with the war in Korea that people figured, with inflation spiking, maybe we should start doing something. But this year gives you a size of the deficit, in 42 to 46, 15, 28, 30, and 23, 24, 7. I mean, you have seen pictures of the debt to GDP. I mean, it really spiked. It obviously spiked during this period. So this year lasted until the Treasury Accord, the Fed Treasury Accord in 51, when Chairman Martin, he, by the way, was a very strong believer that he could control inflation by raising interest rates. So they make the accord here. This is, right at the spike during the Korea War. Okay, this inflation surge, and then they start raising rate. The inflation surge is over by the end of the year, 51. Right, by end of 51, so the accord is made, and actually Truman was very upset because he had come from the Treasury, so he thought he was an ally and called him a traitor for raising interest rate this much above the pact. So the raising interest rate is seldom, but this is what the court said. that the two reached accord with respect to debt management, monetary policy to pursue blah, blah, blah. They essentially asserted their own independence. And basically in between and all the way until the late 60s, so he's the longest serving chairman in the history of the Fed, prices were relatively stable in historical context until Lyndon Johnson becomes president. And if you have read anything about Lyndon Johnson, he's probably one of the biggest bully in American political history. So there's the Vietnam War, okay? There's the Vietnam War, but there's also his idea of great society. He wanted to be the next FDR, and he implemented Kennedy's tax cuts. So this is when the Fed raised rates in 65. This is his comment to him: Martin, my boys are dying in Vietnam and you won't print the money I need to save them. You're raising interest rate while American soldiers are bleeding in rice paddies. Where is your patriotism? And he basically then invited him to his ranch and assaulted him, pushed him against the wall. And there's a big, imposing man and was pointing at him. And then he would make a habit out of asking him to come to the White House and have him wait for 3 hours before he would speak to him. So he would call him multiple times a day. So he was just harassing him, and Martin later confessed, to my ever shame, I finally gave in. And that's when we see the. So in other words, he just bullied that's why I think it makes sense to think about that. It's just a question of degree. He just really bullied them into cutting rates. And we saw this. Now the great inflation is a bit different because it turns out that Arthur Burns didn't think interest rate did anything to bring down inflation. Now, if you have a chairman that says that raising interest rate is not going to do much to bring down inflation, well, inflation expectation are probably going to start moving around quite a bit. And that is exactly what we had seen. And this is from the Nixon tapes that were released after Watergate. And then sort of as a real attitude comes out, Mr. President, if I raise interest rate to level need to stop inflation, you'd have an unemployment rate that would make the depression look like prosperity. The cure would be worse than the disease. He just thought it was so costly. I mean, there was this belief in these crazy trade-offs at the time. And that sort of explained the 70s. We've talked about the 20s. I want to leave a couple of minutes for Q&A. I talked about it, but I think the role of the policy, but I think that's a different story too. I think that was just more that people had the wrong framework as opposed to the fiscal authorities, or having anything to do with fiscal theory of the price level in the way. There was nobody, bringing Powell. I mean, Biden was not bringing Powell to any ranch and pushing him up against the wall and screaming at him. I mean, now we may there's that kind of bullying going on, but it doesn't seem to have had much effect yet. Okay, so let me just open up for I'm sorry, I left too little time here for.
I think we're well on time for questions from the audience. Benoit?
Thank you. So one piece of advertisement and one question. So my colleague, former colleague of many people in the room, Frank Smets, and Ralph Wouters, they have a paper doing kind of the same thing. It doesn't need to be either or. So they have this parameter which can take a value between 0 and 1, and it corresponds to the unfunded fiscal shocks. And in terms of conclusion, they concur that they conclude that 80% of the variance of inflation is monetary. And so it's only in a few instances that they had fiscal shock leading to inflation, but the sample period is not exactly the same as yours. But I'd like to ask you about another country which has a very large fiscal problem, but far from here, far from the US, where the question of independence is not on the table because the central bank is part of the government, and it's a large country. It's in Asia, and so there, I mean, there's an issue.
Are we talking about China or Japan or both?
Well, actually, in the case of Japan, independence is, I think, closer to the way we think of independence of the central bank. But in China, it's not an issue of the independence of the central bank, and yet, you know, they're really struggling to lift inflation above zero, even though they have a very large debt problem. I mean, it's local government debt, but still, it's a fiscal. There is a fiscal problem there, and so I wonder, you know, how much the financial system exposure to public debt is part of the equation that we should think about. And in the end, is it not what makes the US different? If the financial system is somewhat less exposed to the sovereign debt than the banking system.
So I mean, your question, which is they're having a lot of debt and have difficulty in bringing up inflation. That's why I like modeling this in the way I'm doing. I had a Taylor rule there where there was just a weight on debt. Now, if you have a zero bound, a constraint, well, then debt is not, you know, you can't go below. So monetary, you know, inflation is a monetary phenomena. If you can just raise to get rid of it, it may be more complicated when, you know, in Japanese situation, you're up against that bound, and who cares what the value, how they would react to debt until interest rate become positive. And I think my guess is that's the difference relative to the paper you referred to. So I prefer actually modeling it as monetary policy, always having full control in a sense, as long that the interest rate can be set so as to guarantee whatever inflation you'd like. It's just a question of how much push you get from fiscal authorities. And I think that's, you know, why the ECB is designed like it is, that people didn't want too much debt because that created incentive for member countries to push for lower rates. Well, didn't quite work out, I guess, those debt limits. But, you know, I think it's just through these pressures that it manifests itself as opposed to some mysterious transversality condition or exogenous primary surpluses or things of that kind. Yeah.
Jean-Paul?
Thank you. That was a very insightful presentation and masterfully delivered. So I'd like to help you make sense of the last two episodes, Gauti, by going back to Friedman's quote, and especially the second part of the quote, which I think you know, everybody focuses on the first part. So the full quote reads, "Inflation is always and everywhere a monetary phenomenon," and continues, "in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output."
So I didn't include that because I don't agree with that.
Okay, but so let me explain you why I think it would help you. When do you have a more rapid increase in money than in output? When you have capacity constraints. When do you have capacity constraints? When the labor market is tight. And that's exactly what you're showing. So in other words, if you have an increase in money that doesn't hit capacity constraints, you don't see inflation. So the reason I'm bringing this up is because it seems to me that conceptually the kicking point is when you have capacity constraints, and that tells you inflation is, you know, the supply part of it is very important. And so why is that important? Because it helps you, as you I think very well did, rationalize the first four. But when you think about inflation, about supply, it also tells you, well, what causes also supply problems, not only labor market tightness, but also commodity shocks.
Oh, sure.
And so, you know,
sure.
You know, why is it? What the bottom line of my question is? Do you also sort of think about it the same way as I do, which is that the capacity constraint and the supply side of it is crucial?
Yeah.
It's not only just about money.
No. So I mean, to be clear, like in the paper, I have with Pier Paolo where this picture sort of early version come from. What can shift capacity to is not, you know, it's not fixed. It could also be shifted by rise in commodity prices. And in fact, we have empirical work where we show that once you are at that capacity constraint, commodity price shocks start having a lot bigger effect on inflation precisely for that reason. About the latter part of Friedman's quote, the reason why I didn't include it is that, I mean, what is money supply these days? Reserves plus currency? reserves are just government debt now, interest-bearing government debt? Or are we going to start counting up like they did deposit and which deposits? I just don't think any notion of money has any. I think it's the interest rate that is the relevant margin. Like I think, central bankers have been saying that. I remember going to the Central Bank of Iceland when I was an undergraduate, and it was the first thing the head of the central bank said. Academics are always talking about the money supply. I have no idea why. We just care about the interest rates. And I think that's because notions of money supply, the Fed stopped collecting M3. We had M3, M2, M1. I'm just not sure it's all that useful. It is the interest rate that is the.
But that also applies to the first part of the quote.
No, well, I'm interpreting monetary phenomena as the central bank can control it. I'm just arguing with him that is through the interest rate. And that's like, his broad point was that the inflation was the responsibility of the Fed. And that I agree with. So now, then it's a technical question of how you actually implement it.
I think we agree much more than we did. Sounds like.
Yeah.
All I'm trying to say is I think bringing in the notion of the supply side of the economy into the picture is super helpful to.
Yeah, so that's what. For the inflation. That's like what's the point about 5 out of these 6 are literally that's the mechanism, right? The mechanism is that you hit the capacity constraint. It's only the 70s when you don't. But once you hit the capacity constraint, I emphasize labor, but you could put any other input as well. Any input is going to have a bigger effect when you cannot substitute with labor, which is the biggest input for most production. And when you cannot make any substitution, yeah, you can have a bigger effect. That's one of the things we show in the paper. That
We have 2 more questions in the pipeline, maybe 3 with Guido.
Thank you so much. I join Jean-Paul in the compliments and kudos for the insightful presentation. If we take, I very much share your framework of thought, and if we try to somehow use it in the real context of the Eurozone and the Euro system, where we've got certain heterogeneity of the sovereign debt and the fiscal constraints or fiscal room to maneuver, what do we need to be careful about when we try to apply this kind of thinking from central bank or Eurosystem perspective, given the fact that we've got one interest rate and very many different fiscal pressures on the supply of money?
My interpretation of the Maastricht Treaty was to try to exactly address that by limiting the amount of debt each member country could hold, because that gives certain incentives in voting at the board. Now, a practical solution that is not less strict than the Maastricht Treaty is that you lose your voting right if your debt goes above a certain level. Or, yeah. Yeah, I think that's something to be taken into. I don't want to make a blanket statement, but no, I think that's a good point. And what is the optimal level of debt, and what is considered safe debt here? And now the U.S. debt is not considered as safe. So that, yeah, that's a consideration I haven't thought about in that context. But just sort of broadly speaking, if you're thinking about lots of different countries and how they may have an impact on monetary policy, I think a Maastricht Treaty has been designed to do that. And then, people may have different view on, but that's how I like to interpret it. But you could have if that is a problem, that certain countries are demanding lower interest rate than others due to those type of issues, there might be ways you can then penalize deviation from on the debt limits.
Have Anton?
Yeah, nice talk. Thanks, Gauti. I tend to agree with you about inflation being mostly a monetary phenomena, but nevertheless, I'd like to push back a bit on the idea that it's always, a monetary phenomenon, because, this inflation was also experienced by many other countries. Not your story is very much US focused, but similar inflation rates were experienced by many advanced economies with different regimes, different fiscal stance, and so on. And so, some of these episodes, at least the timing of those, seem to be synchronized
around world cost shocks, such as oil shocks and supply side phenomena.
Well, I mean, one interpretation of that is that a lot of countries took the lead from the US. And I think a lot of countries did that. I mean, I haven't studied I'm aware of some work looking at countries that started increasing rate earlier, but those also tend to be countries that had less credibility in the first place. So we're seeing inflation expectations moving. So it's a little bit hard to judge that. But yeah, I think it's so I haven't looked at other countries, and it, being from Iceland, I understand the complication of having a small currency and an exchange rate, and but ultimately, I think though the general statement that the Fed could have prevented this by raising rates. Now that would have caused a recession, or more slack than we saw. I mean, that's all. I mean. But that's not denying that the source might have been supply shock or this or that. The Biden stimulus was huge.
I have Guido and then Faccini.
Yeah, so actually, to some extent, Anton anticipated my question. The last episode, but not only the last episode, also the 70s, others. The last episode of inflation surge, but also in the 70s, it was really a global phenomenon, right? Mm-hmm. And going back to Japan, for example, Japan tried everything with domestic policy to increase inflation, as you know very well, and didn't succeed. But then magically, inflation went up in the last 5 years. So there's something that that probably it's important in international debt.
Well, I mean, I think all countries experienced COVID and labor shortage partially because of that, and the kind of same configuration of demand for goods or services. And I mean, if there's one thing that we can say,
for example, is different, but the same thing happened. So that was just one notion. The other thing about this L shape, I think I'm old enough to have looked at these books when I more or less the same age. Yeah. And, if you think about the restaurant idea you said before, then why the restaurant didn't increase the wage? And then we go back to Tom. So there was actually, from the point of view of workers, there was rationing. I mean, according to, with the lens of Tom's model. And then it's very different if rationing is on intermediates or final goods, et cetera, et cetera. But maybe we can go back to the old literature by Axel Legenfood, et cetera, which prices are fixed, wages and or prices and quantity adjust. And then you can have the 3 region. I don't know if you are old enough to remember that.
I was too busy preparing the talk to have fully incorporate the discussion we had earlier about that issue, but that's something that we studied in relation with our paper on the inverse L. And what was important there was that the marginal cost was actually new wages, not labor share, which went down because existing wages went down with the inflation. And if you look at some measures of new wages, like job-to-job transitions wages, or there are these measures from burning glass data, especially in the lower end of the distribution, there seemed to have been quite a bit of pressure, but maybe I think there's also a bit of it, that I haven't modeled, that people thought it was temporary. They didn't want to be offering too high wages because they would be stuck with it. And that's something I haven't seen modeled, but could be some to that. So that would imply then rationing.
The spirit of rationing, I'm afraid I have to ration questions. So maybe you take it bilaterally in the break, or we're a bit running out of time. Or do you want to take one more? Take one more, go ahead. There. Behind you.
Thank you very much. Sorry if I'm taking your time. It was a fantastic talk. Thank you very much. I really like this idea you mentioned about fiscal policy, the regime never being just monetary dominance or fiscal dominance, but being somewhere in a continuum between the two. And I may be biased here because the work with Bianchi and Melosi, when we estimate that share of unfunded debt and how it evolves through the history after the Second World War, that's precisely how we think about it. It's trying to capture where the economy lies in that spectrum that is really a continuum. So I think I get that fiscal theory of the price level that you hinted to. I think I also get your theory of the labor market, the L shape. But should I think of these two theories as two separate theories of inflation that help me make sense of what's going on at different points in time? Or do you have in mind an interaction between the two?
So one is about mechanism. Through what mechanism did inflation show up? It was through tightness in the labor. That was like the inverted L, right? And we were all surprised because we thought the slope of the Phillips curve was so low and inflation weren't moving. So that's about the mechanism. The other is about, well, why didn't they raise rates? And I think the answer to that has much to do with fiscal policy at least in the first three, and certainly explains Lyndon Johnson harassment of Martin. I don't think fiscal consideration were as important for the 2020s. I think that had to do with the new framework. I thought it had to do with misreading of the Phillips curve, relying too much on expectation being stable and too optimistic reading on shocks being temporary and supply side. Yeah.
Thank you very much. Next. Round of applause.